Candlestick patterns are a formation consisting of one or more candles that signals us about an upcoming price reversal. The strategy is called price action, and its founder is considered to be successful trader Lance Begg. He wrote a number of books, which I read with pleasure at one time, and tried to apply the knowledge he imparted to me in my trading. I can't say that this knowledge brought me tremendous success, because this strategy was developed specifically for him. But at that moment, I realized for myself that it was time to finish with indicators and start studying price behavior in depth. In all his books, Lance Begg focuses his attention on the behavior of the formation of candlestick patterns, but for some reason does not analyze the very logic of price action. Therefore, I had to take everything apart myself, and only these efforts allowed me to stop wasting money on the market. Today, we will analyze a number of the most popular candlestick patterns and look into the very essence of their formation in order to understand the logic of price action and why, relying on the signals of one or more candlesticks, we should risk our money. The video will be very educational and interesting, and I left the best parts for the end. Therefore, watch the video to the end. But first, according to YouTube statistics, 92% of viewers watch my videos without subscribing to the channel. Therefore, I have a huge request to you to subscribe to my Pipsley Trade channel. Your subscription and activity in the form of likes and comments encourages me to create more useful content for you. I am sure that you have subscribed to my channel because it is not difficult for you, but I am pleased. In order to look inside the candle, we need to use the 1 to 5 rule. Let me explain what this means. We will use a 1-minute time frame to find an entry point and look for the pattern itself on a 5-minute time frame, or the entry point on a 5-minute chart and look at the pattern on a 25-minute time frame. Since a 20-minute time frame does not exist, this means we will use a 30-minute one. I hope you get the idea. We will look at the 3 most common and most frequently seen candlestick patterns on charts. But looking ahead, I will say that all candlestick patterns work only from levels, and even better, after liquidity has been removed. Then the percentage of profitable trades will be much higher. Pattern number 1, bullish or bearish engulfing. This is a pattern that signals to us that one player has begun to dominate the other and is trying to reverse the price. We are presented with pictures of its formation, which is built from only 2 candles. But if, in addition, we take another candle that was formed in front of the candlestick pattern and logically draw the price movement of each candle, then the picture will become more logical. As you can see, we have a graphic pattern, although if we remove the drawn lines, the logic is immediately lost. Remember that the price always unfolds in graphic patterns, and candles only show us the movement that was traded over a certain period of time inside the candle. And to see this movement, we need to go down to the time frames below. Let's return the lines that I drew on the candlestick model and go down to a time frame that is 5 times smaller. In my example, I took the hourly time frame as the main one and the 15-minute one to see the logic of the formation of price movement. As you can see on your screens, we correctly marked the price movement on the hourly chart. On the 15-minute time frame, a reversal pattern was formed, which we clearly see in front of us. Should I open a trade immediately when the engulfing candle is broken? Maybe. But as for me, the price almost always returns to the inner candle zone. Also, if you pay attention to the 15-minute chart, the same candlestick pattern was formed. When the hourly candle was broken, the price returned to the zone of the inner 15-minute candle, which reduces our stop loss by almost 3. And this is not magic. These are just my observations on which I spent a lot of time. I've always been interested in following the price and understanding its logic. Pattern number 2. Inside bar. This is a pattern that shows us a price slowdown and a subsequent market reversal. As a rule, it is formed after liquidity has been removed from significant levels. An impulse movement that removes stop losses, and then the price slows down, gaining volume for a reversal. The inside bar model is also presented to us as a model consisting of 2 candles, where a position is opened when the inside bar is broken. But if you look at the history of this formation, you will see that sometimes in the inside candle zone, several inside candles are formed, which manipulate each other. And believe me, psychological manipulation is difficult to endure. Therefore, I would consider entering the market when the inside candle itself is broken. Well, how profitable is it? to open a position on the breakdown of an inside candle. To do this, we need to understand how the price moved to form this candlestick pattern. Also, to get more information, I would complement this candlestick pattern with 2 candles on the sides. Now, let's plot the price movement lines on the candles and see the formation of a graphical pattern. For a clearer picture, we will move to a lower time frame of 5 times, and lo and behold, a full-fledged reversal pattern appears in front of us. And I explained in detail how to trade from it in my video on the channel. As you can see, the price always unfolds in graphic patterns. Of course, there are several types of patterns, and each has its own logic of formation. To become familiar with frequently recurring price reversal patterns, you need to watch my video, Reversal Patterns. In it, I tell the logic of their formation. I also show how to trade them correctly from the place where the position was opened to the place where the stop loss was placed. I recommend you watch it and look forward to your comments and likes. Of course, in the inside bar pattern, you can enter when the inside candle is broken, but then the stop loss will be larger than it could be. Let's find out why. The inner candle is an accumulation candle, which means that a major player in this place was accumulating his position. When exiting accumulation, price moves back to test this area and fill in price inefficiencies. This means that with a high degree of probability, the price will return to the inner candle zone. From there, we can enter the position. And just look how the stop loss has decreased compared to the first entry option. Isn't it excellent? Pattern number 4, pin bar. To be honest, I would combine the pin bar candlestick formation with several other candlestick patterns. For example, hammer, hangman, dragonfly, night star or shining star, and several more species. Who gave them all these names? Their imagination is the envy of many. Why did I combine them all into one group? It's simple. We will look at their movement logic from the inside and make sure that the logic is almost the same. And if so, then why fill your head with various other names for the same formation? In order to fully understand what kind of pattern is being formed in this model, we need to add 2 more candles on the sides of the pin bar. In order not to waste time, I will immediately say that we need to wait for the first candle to break. With this action, the price gives us confirmation that the trend has broken. In a way, this acts as an additional factor or filter for this candlestick pattern. Let's look at this model without the previously stated confirmation. As you can see, after the formation of a pin bar and the first candle not updating, the price can continue its main movement. Now let's look at what kind of graphical pattern is formed inside this candlestick formation. Look, inside 3 candles of the higher time frame, a reversal pattern was formed from which we can open our position. If you don't look at lower time frames, but look only at the candlestick pattern, then when a side candle is broken, the price almost always returns to test the first candle. I often use this knowledge in my trading, as it has a logical explanation and statistical dynamics. You can also use them in your trading as an addition to your main trading system. In the next video, we will look at a few more candlestick patterns that are also present on the charts. They are no longer formed so often, but they also have good training and statistics. In general, that's all I wanted to tell you in this video. I hope you liked it, and this information is worthy of a like. Good mood to everyone, and more profitable days. Bye.